If you've been wondering why mortgage rates refuse to fall, why stocks randomly freak out, and why financial conditions feel tight even when rate cuts are on the table, you're looking in the wrong place. The headlines consistently point fingers at Washington. They blame domestic inflation, political administrations, and most reliably, the chairman of the Federal Reserve. But Jerome Powell and his colleagues actually operate with a very limited set of tools. They directly control the short-term overnight interest rate. That's it. To find the lever that actually dictates the cost of long-term global money, you have to cross the Pacific. The answer starts in Tokyo. For the last 30 years, the structural integrity of the entire global financial system has relied almost entirely on the most boring asset on Earth, Japanese government bonds. Rewind to 1992. Japan's massive equity and real estate bubble burst. The economy crashed, triggering 3 decades of zero growth, zero inflation, and stagnant wages. Out of options, the Bank of Japan deployed a desperate monetary response. They cut interest rates to zero. When that didn't stimulate the economy, they pushed them completely below zero. This graph illustrates their final move, yield curve control. The Japanese government stepped in and forcefully pinned the yield on long-term bonds flat against the floor, entirely ignoring what the free market actually demanded. This created an impossible math problem for domestic investors. Imagine managing a billion-dollar Japanese pension fund, and your mandatory government bond portfolio pays you exactly 0%. Holding cash wasn't an option, so Japanese institutions packed up their capital and went on a massive global shopping spree to find higher returns overseas. This flowchart maps how the trade operated. An investor borrows Japanese yen at near-zero rates. They convert that free yen into US dollars, buying US treasuries yielding 4%. After hedging costs, the investor gets to pocket the spread. When borrowing costs are negligible, capital gets highly aggressive. Investors stopped at just buying safe treasuries and started pouring this cheap money into tech stocks, commercial real estate, and emerging markets around the world. At its peak, this multi-trillion-dollar trade acted as the primary engine for global market liquidity. It powered the financial system flawlessly, running entirely on the assumption that Japanese yields would stay near zero forever. In 2024, that assumption broke. The Bank of Japan officially ended its yield curve control policy and raised interest rates for the first time in 17 years. As Japanese yields ticked up, the mechanics of the trade broke down. Borrowing in yen became expensive. Hedging against currency fluctuations became expensive. That profitable 4% spread completely evaporated. This triggered repatriation. Decades worth of capital that had flowed smoothly out of Japan suddenly whipped around and rushed back to its origin point. Following the central bank's second rate hike, the S&P 500 dropped 6%, and Japan's Nikkei 225 plummeted over 12% in a single day, its worst drop since 1987. When the underlying mathematical formula of the carry trade fails, the world's cheapest, most abundant source of liquidity instantly vanishes. For 30 years, Japan acted as the ultimate price-insensitive buyer. They consistently absorbed massive amounts of long-term United States debt without demanding higher premiums. Now, Japan is backing away precisely when America needs them most. The U.S. government is running trillion-dollar annual deficits, requiring a constant, heavy stream of new buyers just to keep the lights on. This animated scale demonstrates the resulting supply and demand crisis. With a growing mountain of new debt supply and a shrinking pool of foreign buyers, the U.S. has to let long-term bond yields climb significantly to attract anyone willing to hold it. According to investor Ray Dalio, the bond market is the backbone of the entire global economy. It represents the baseline interest rate that dictates the eventual returns for all other asset classes. This dynamic creates a steepening yield curve. The Federal Reserve can cut their short-term rates all they want, but a lack of global demand means the long end of the curve stays stubbornly pinned at the top. High long-term yields rewrite the models for the stock market. Analysts value equities by discounting future cash flows against these baseline rates. When the baseline stays elevated, the present value of those future earnings decreases, forcing stock valuations to compress. The housing market faces the exact same mathematical ceiling. Standard 30-year mortgages are anchored directly to long-term Treasury yields. If the Treasury yield doesn't fall, housing affordability stays brutally strained. Down at the corporate level, high borrowing costs act like a tourniquet. Credit is the bloodstream of business expansion, and when capital gets expensive, risk appetite dies, deal flow halts, and corporate growth slows to a crawl. The era of cheap, automatic global liquidity is over. A single rate hike in Tokyo stripped the oxygen out of markets worldwide. The greatest threats to our economy aren't the loud, trending headlines dominating social media. They are the quiet, mechanical shifts in the bond market, hiding entirely in plain sight.